Every business acquisition comes with its own set of risks, which scares most people. So what separates the professionals from the newbies is that the professionals know how to assess, quantify, and minimize the risk associated with the deal. It's not just about the cash flow, it's about the risk that comes with it. So looking at every potential risk from every angle is what helps you minimize the risk to optimize the cash flow. Imagine, if you will, you had an opportunity to capture $500,000 a year in income, in cash flow for you, added to your family with very, very little risk. Will you do it? And that's what the subject of this video is all about, helping you how to evaluate risk when you're buying a business. Let's get to it. My name is Landaverde. I am a business broker and commercial lender helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth, or a W-2 employee sick and tired of the rat race, wanting to leave it behind because you worry about layoffs and you want to secure your own destiny as a CEO of your own company, you're in the right place. Please subscribe to my channel. Don't forget to hit the bell and you'll be notified every Thursday when new content comes out. Okay, so today we're going to talk about the inherent risks of buying a business. And we're going to divide them into 5 buckets. 5 different types of analysis you have to do, which inside of our group we call the due diligence list. So we're going to break it down into 5 different components. Number 1 is understanding. So it's market risk, operational risk, financial risk, legal risk, people risk. All right, so let's get into the first one, market risk. Now, one of the things that I say quite a bit and something that I believe strongly is that when you're buying a business, you have to look at the market size. You have to look at the overall industry NAICS codes. You have to understand what you're getting yourself into. What I'm looking for is a business that is an industry has at least 25,000 units that can be resold, 25,000 units, no less. Now, can you go with an industry that has 20,000 units? Yes. And we talk in depth about what that is. What it means for you is that if you were looking into opportunity to basically do a roll-up and you're looking for a foundational company that you can build on, that is exactly what that is. So whenever you have a business that has a lot of demand and it has a lot of units, it allows for resale opportunities. So you can eventually sell to somebody else, you can buy from somebody else. There's a market associated with that specific industry you want to get yourself into. If it is a one-off, may not be a good thing. If somebody is too early into the market, and they have something that is so novel that could change the world, but there's only 1 or 2 of them, and that is significant risk that I'm not sure that I would go with. I like tried and true industries that have been around for a long time, that provide this consistent cash flow. So market, you look to the market, and there are tools that we use to do that. There are tools that we use to use where we can actually, software allows us to look at key points, key performance indicators on any industry, the number of units, the size of the market in terms of billions in revenue, the average size of the average business, how the businesses are evaluated depending when they go from 0 to 1 million in revenue, 1 to 5 million in revenue, 5 to 20 or so in million in revenue. And the space that we're looking at is typically somewhere between purchase price between $1 and $5 million. So when you're looking at that, what I'm looking for is rules of thumb and then what should be looking into the market. Now, there are some industries that I know very, very well. But there are some industries that I know as much. And as a licensed business broker, whenever I take a listing on an industry I don't know much about yet, my job is to become subject matter expert in that industry if I'm going to represent the seller. So whether it is light manufacturing, professional services, or the trades, there are rules of thumbs that you need to understand. You need to understand what happens in that business. So when you buy it or sell it, what happens to the inventory? How much inventory should you get? What happens to the working capital? Does it come with the deal? Does it not? Do you need it? What about the burn rates? What about the average profit margin and the average cost of goods sold in any industry? What is the standard? You need to know what that is. And you need to compare the business that you're buying to those standards. So knowing a lot about the market helps. So I tell folks, look, when you put into your buy box together and you choose about 3 industries, you don't want to become a jack of all trades. You want to become a master of a few. And those, you need to understand the rules of thumbs for those. And it helps if you know something a little bit about that industry. Number 2, we go into operational risk. Now, this is something that is often not really paid attention to when in the due diligence process. You let the folks, the CPAs, the financial people do the financial analysis. You hire the attorney to do the legal risk. But who is actually minding the operations of the business? That is you. You're buying this business. You want to know basically revenue concentration issues, vendor concentration issues. Now, if you're dealing with a professional broker and you have to prepare a very comprehensive confidential information memorandum, all those things are going to be itemized there. But I wouldn't take their word for it. Your job is to dive deeper. You need to understand what is the worst thing that can happen in this business, and if it happens operationally, will that be okay? Say, for instance, one customer represents 20% of the revenue, and you have a 20% net profit margin. So if that 20% revenue customer goes away, there goes your 20% net margin, so you're breaking even. So how do you mitigate it? Knowledge is power when buying a business. So what do you know about this customer? Are they in a multi-year agreement? What is the likelihood that they're going to stay on after you buy the business? Have they been with the current seller for 20 plus years? If this is a circumstantial case that they're not going to go away, well, then the risk is mitigated. Vendor concentrations. We want to understand, if you scale, can you rely on the same vendors? Are there vendors that have a very strong supply chain? Depending on the industry that you're in, the supplier reliability and the scalability of the business. And you want to look into the operations. How are the operations being run? Are there standard operating procedure protocols? Do they have an SOP book? Now, is all the knowledge sitting in people's heads? If so, you got a problem. But if all the knowledge is being carefully laid out in a standard operating procedure manual, things like sales and marketing and HR and operations, how to take an order, how to send collection letters, what the accounting software, all of those things should be dialed in. So really what you're buying is an SOP book that has everything you'll ever need. But most sellers will not create one, which is, this is what happens in the smaller businesses. So your job is to assemble as you go into buying this business. What does the SOPs look like? Okay, so moving on to, we're going to talk about now financial risk. Well, we spend quite a bit of time doing financial analysis before we make an offer. Now, inside of our group, we have what we call the Deal Analyzer 3.0, which the Deal Analyzer 2.0, I give away. But the Deal Analyzer 3.0 has over 100 formulas, over 9 sheets long. Well, what I'm looking for is figure out, what does this deal look like? What is our deal structure is going to look like? What is the optimal value range for this deal? What is the average 3-year SDE? What is the average 3-year adjusted EBITDA? Do we come in and operate it? What is the strategy for you in your buy box? Are you going to come in and insert a GM or have one of the key employees stand as a GM? Where you truly are the investor, you get to keep your day job or whatever else you do. You may actually own another business and you have somebody who's going to run that business. That takes know-how and that takes financial savvy. So, we want to understand things like the balance sheet. You're going to lean on your due diligence person to help you with things like working capital calculations. You're stuck in trying to figure out how to buy a business, how to do it right, when to evaluate, when to get pre-approved by a lender, how to analyze the tax returns, how to figure out what is the optimal price or multiple you should pay for this business, what about the post-debt service cash flow, and many more questions I'm sure you have. I would love to help you and hop on a Zoom call or a complimentary call to help you out, buy a business. So all you have to do is reach out to me. You can send me an email directly and just mention that you watch me on YouTube. And my email address will be up here and also in the description section of this video. And you can just drop me a comment and start a conversation. And that's how I've been able to help many folks buy a business this year. Connect with me. Liquidity, current ratio, debt to equity ratio. Is there any anomalies in the financials? Luckily, you're going to have somebody by your side doing asset testing on the balance sheet, the P&L, and the statement of cash flows. There's a myriad of things that can go wrong, and a lot of sellers hide things in the financials. This is why you do not want to do your own due diligence. For instance, when we're doing financial diligence, we want to understand historical perspective. It's not unusual to look back when you're doing due diligence, if you can, before you buy a business. The best due diligence happens before you make an offer. You want to make your due diligence post LOI to be incidental. You already did all the work. You vetted the tax returns, they match the interim financials, and you have a spread. And one of it, the Deal Analyzer 3.0, we have this spread that allows us to, we call it the OC tab, that allows us to verify information on the operating concern of the business up to 5 years. We want to look at revenue year over year, cost of goods year over year. We want to look at gross profit year over year, and the percentages of each are the percentages going up or down. Is the cost of goods increasing every year? Why? Right? Is the cost of goods going down every year? Why? Is the revenue staying flat? Why? What's the opportunity? How do you minimize the risk? At every turn, we're looking at risk mitigation. That's how you assess the risk. Now, beauty is in the eye of the beholder. We did an analysis yesterday on a deal where the potential buyer, who is a member of our group, knows a little bit about that industry and is actually a vendor who is actually in the supply chain of this guy who does a really, really good job at this industry trade. You want to pick up this vendor, you want to capture the supply chain. It's a manufacturing facility because he knows a lot about the industry. There are some blemishes on the deal that we're working through, but because he knows how to optimize it and turn around, it's great. And it's the thing. You're buying a business not for the existing cash flow, although you're paying for the existing cash flow. You're buying it for what it can become in the future. If you can double it in 5 years or less, that's the rule. So that gives you a little bit about what are the things that we look at under the financial risk. Obviously, you want to look at pre and post debt service cash flow. We want to asset test the market and figure out what happens when we have stress on the deal. There's a way that we do that to figure out what is the post debt service cash flow. Looking at that, when is your break even analysis? How much post debt service cash flow is after servicing the debt, and does it allow you for capital expenditures? How much money you're going to keep in the bank? How asset heavy is the deal? How are we going to depreciate those assets? How often do you need to buy that equipment that run the business? It's basically, we're going to look under the hood and figure out how the numbers work. That's the financial analysis. Legal risk. Legal risk, that's when you need the attorney, an M&A attorney on your team. I always talk about get your deal team together. You got your M&A attorney, you got your due diligence person, you got your SBA lender or 2 or 3 or 4, whatever, how many do you need to get the deal done? And you get somebody like me as the M&A advisor is basically co-piloting the deal with you. So risk, legal risk. Now, are there any pending lawsuits? What do we know about if you're buying the assets, you don't really worry much about the stock, but you want to know what is the reputation. Are there any legal blemishes, workers' comps, lawsuits, and labor litigation? Is there a union involved? Is there a collective bargaining agreement? Any UCC filings? Is there any things that their attorneys know how to pull some information from certain databases for attorneys that allows them to understand, get a kind of temperature check on what the business is doing legally. And there's ways that you can go into the Secretary of State and to the State Controller's Office for that particular state and see what type of legal risk you're dealing with, if any. You may not have any finance. It's really, usually there's not, the sellers, I give them a lot of credit. If you've been operating a business for 20, 30 years, you learn how to run the business to minimize litigation. And they have very, very good attorneys. The bigger the business, the better, right? Because they have a lot more to protect. They have a good legal attorney, and which means that your attorneys, you're looking at contracts, you're looking at employment agreements, anything that has to be fully executed, a legally binding agreement. You want to have your attorney look at those. Like your lease, you're buying a business and there's a lease involved. If you're getting an SBA loan, there's going to be a trigger of change in ownership, which means the landlord is going to have to give you a new lease. Well, that lease is going to produce a new lease agreement. However it's stated, it's going to have provisions and warranties. And also you want to have an attorney to look at the asset purchase agreement and all those documents that are going to come in with buying a business. There's a lot of legal risk that you analyze, but we do it in the context of helping you, and we've done it enough of it that we know what to look for, and we team up, you and me, team up with the M&A attorney to do that. Now, last but not least, number 5 is people risk. Now, this is when we look at, people often neglect when you're buying a business that has employees, that the employees actually have a say. This is not like when you're buying a piece of commercial real estate in which you're buying the asset doesn't talk back. Employees, if they're unhappy, they may not go with the deal. If they hate the seller, they may not go with you. They may all quit. There's a lot of things that can happen. You need to get in front of that right away. If the business has 10, 20 employees, you need to understand, are the employees happy? What is the employee turnover? How often do they have to hire? Is there any employment roadblocks? Is there any positions that are unfilled? Why? There are some trade industries that are struggling to actually hire qualified workers. Well, what is the process of hiring people? What is the employee retention? When was the last time somebody got laid off? Or do employees come in? Are they lining up the door to want to join the business? It has to do with the brand. People happiness index. You want to figure out a way, and there's ways that we do that when you started the deal, to actually be introduced to employees. At some point, employees need to be told that the business is being sold. Well, how's that going to happen? And at every turn, we're looking to minimize the risk. Now, I want you to think in terms of employees as assets, not liabilities. But they can go from assets to liabilities very, very quickly if you don't take care of them. You are buying human assets that can really power up your business. And one of them may be the next GM. So you got to proceed carefully. People risk, it's like handling, that's the part of the due diligence process, or the part of the analysis that is the most sensitive. You got to go with white gloves and really take care of folks. And there's confidentiality provisions, even in the LOI, even prior to signing the asset purchase agreement, that you need to really respect. Confidentiality is everything, especially when it comes to dealing with people. Guys, there's a lot more where that came from. So I'll be doing more videos about that. So hopefully you enjoyed this one. For a limited time, I'm giving away my cash flow calculator, the Deal Analyzer 2.0, which has helped thousands of folks do the first pass of deal analyzing on any deal. Whether you want to move forward or not, having the key components of the things that we talk about, like debt service coverage ratio, post-debt service cash flow, really help. It is a free tool that I built just to help you guys out. Also, my buyer's checklist, which is 6 pages worth of information that you're going to need to when you buy a business. I'm giving those away for free to you. And in exchange, all you have to do is provide your email address so you can be added to my email list. If so, please go ahead and do so. I hope they help you out. Thank you so much.